Welcome back, Team 201. Next stop in our journey through the accounting process and through the framework is looking at the concept of recognition. So far, we've been summarizing this journey of ours through the framework with this blank piece of paper, which isn't blank anymore, as you can see. And we've got there and got the blank piece of paper away with some elements on it by going through various processes. First of all, we needed to think, okay, there's an economic event. Now we had to then think that economic event. I want to give useful information about that economic event to the users of my financial statements, to the users of this blank piece of paper. And to decide whether that information is useful, we consider the qualitative characteristics. Can I faithfully represent it? Is it relevant to their decision making? And how do I enhance those with the enhancing characteristics that I get the best, most useful information for my users? Then we stopped in the last video and we said, right, we have this economic event. We want to give useful information on it. That stop was then to have a look at the elements. The elements are your assets, your liabilities, your equity, your income, and expenses. You have to be able to classify those elements based on those definitions with your economic event. So you have to understand your economic event and then know your element definitions and be able to put the two together to come to a conclusion. Now, just because you can classify it as an element, it doesn't mean it meets recognition in your financial statements yet. There's one more step, and that's what we discuss in this video now. So we have these elements. So very important, please, if you're asked to discuss recognition, you first of all need to establish if there's an element. Once you've established there's elements, now you go to the next step in your recognition criteria, and that's going to be whether we can give relevant and faithfully represented information. Now, recognition all comes down to accrual accounting. It's not recognizing these things when the cash flow happens, like in a cash flow statement, or maybe some non-profit entities that use the cash basis of accounting. Remember, in IFRS, we're on the accrual basis. And to achieve the accrual basis, that means we recognize elements when they can meet the definition of the elements, and then they satisfy the recognition criteria in the framework, which comes down to basically being, can I give that information in a relevant and faithfully represented way? Then the framework says there's no hard and fast rule for all of these things. You need to apply a professional judgment in coming to the conclusion. So there's quite a few paragraphs to try and help you come to the conclusion whether you can recognize this thing now, whether it's going to give you information. And it also then gives you some guidance in the case of perhaps you are looking at an element, you want to faithfully represent it, but the one thing that's a problem to you is measurement. You can't quite measure this thing perfectly. You've got a lot of hunches, you've got a lot of guesses. You may be contacting your friends that are actuaries or other CAs, or whatever the case is, to work out what's the best way to measure this. And then you're going to have to make a call that the measurement that you get, is that useful enough to the users? So if you can get any sort of use out of that information, it's probably better to give it than to not give it, because not giving it might really influence decisions more than giving a little bit. But you might also come to the conclusion, you know what, I want to warn my users about this. I want to give them a heads up, but I really, really am battling to measure this thing. Well, then instead of not giving something, maybe just put it in the notes. And this is something you're going to come through in a standard later on. We'll do this year as IS 37 with your provisions. And we'll discuss it in more detail then. So just to summarize at this point, I want to recognize something, then it needs to be relevant to the user, so to make it useful, and I must be able to faithfully represent it. Then at the bottom of this screen, you can see that cost constraint. And that really will talk to the whole measurement issue. I mean, I said in my example now, consult actuaries, consult other CAs. Well, yeah, consult them. Maybe they're nice and friends of yours and they'll do it for free, but others are going to charge you a lot of money to do that. Then you need to start thinking and trading off the benefit of doing that or not. What's going to help you? But generally, this cost constraint, the ISB prefers it to be used by them when setting a standard, because they're worried that people are going to use this cost constraint as a backdoor to always just say, oh, no, it's too expensive versus the benefit. So the ISB prefers not to leave that judgment of the cost versus benefit up to the individual preparers. And then they rather try and work that into setting standards. And when they set the standards, consider what you should get and what you shouldn't get, that people don't just use it as an easy way out. Then another thing with recognition to remember is there's a linkage between recognition of your components in your statement of financial position and the statement of profit and loss. You might have an asset, so you've received money perhaps from a sale. So then you'd have the recognition of the sale at that point in time. So you've got the income being recognized and you've got an asset being recognized. They both meet an element definition and they've both met your recognition criteria. So please, just on this, be careful of that matching concept they taught you at school. Matching doesn't really have a place in the conceptual framework. It's more of a coincidence that things get matched. Now, what do I mean by that? Let me give you the example that comes out at school a lot. And they usually say, match your cost of sales to your sales. Yes, that normally does happen, and that makes sense because the economic event sort of matches it. I mean, I've done a sale, I've incurred the costs. But in accounting, that's not really the reason why you recognize the sale and recognize the cost of sale. You recognize the sale in accrual accounting meeting the recognition criteria. And you recognize the cost of sale when you meet the element definitions, the recognition applying accrual accounting again. If they match in the same period, well, that's more good luck than good management. Then the last section of the framework in chapter 5 that deals with recognition just talks about derecognition. And again, this is just the opposite. It's taking things out of your accounting records that's no longer useful information or no longer faithfully represented as being your assets because you've perhaps lost control of it, or no longer faithfully represented as being your liability because you've extinguished the obligation. You don't owe anybody any money anymore. So if we pull all of that together, the blank piece of paper, you'll now see I've added the debit and the credit to it. And the reason I've done that now is because with recognition, that tells you if I can bring this into the books. Up to this point, we'd been looking at making information useful. We'd considered if we'd met the elements definitions. And now I have met the recognition criteria as well. So now I can bring it in to my accounting records with that debit and that credit.